ask questions. So with that, we will start. My name is Paul Siegel. I'm from Starweaver. This program is a webinar that Doug Carroll will be facilitating, as he has with other programs. This program is about financial firms and their roles in the operation of the financial system. I'm going to spend about 1 or 2 minutes briefly introducing Starweaver and what we do and what we're all about, and then pass it off to Doug, and he'll be able to take this program further. So we are a program, training and professional development company, and our tagline, Education You Can Bank On, really focuses on the fact that you get certainty in terms of the quality and the level and the depth of the program that you will experience. We have lots of global clients. We work in pretty much every major continent, every major center where there's technology and where there's finance, often at the crossroads of those two. Our focus is these 5 areas: cutting-edge IT, traditional enterprise IT, project management, finance and banking, and business skills, and obviously the program today is the finance and banking program. A lot of what we do is online, but a lot of what we do is also in person. And everything we do is driven by practitioners like Doug, who have been in the business, who understand the nuances as it is in the real world as opposed to the academic world, and therefore you get real opportunity to ask questions about how things happen in the world that you work in. If you were to take one of our courses online, this is a video-based course. This is, in fact, a technical writing course by Dan Graham. You will see videos, mini videos, cut into 8 to 10-minute sections, so you can consume them, anytime you want, in short snippets. We do run an institute called the Starweaver Institute, starweaverinstitute.org. There are programs there that you can individually buy. Again, most of our clients are large companies, but we also have done training for individuals, actually tens of thousands of individuals, through our online portal. This program, again, is today, the 29th of June at 1 p.m. There's another program, coincidentally, tomorrow on TOGAF, which are technology frameworks, and then there are 2 more programs upcoming in the fintech world, the finance world, and FinTalk world that we are covering, but we will be adding, within the next week, we'll be adding about 6 more webinars, and so you can check back on our website to find those. Doug will tell you a little about himself, but he's a long history in the derivative and the fixed income world. If you have any questions about anything, terminology, phrases, things that you just have heard of and don't know, this is the opportunity to ask them. So just for participating today, please fill out the little link that Rand will post in the chat box on the right. You'll get a free access to, lifetime access to one of these courses. You'll choose which one you want. And Doug has facilitated a variety of those, so it's an opportunity to experience these and take them home with you for life. Again, go to surveymonkey.com with /RHHZS85D. Again, Rand will put it in the chat box so you can click the link. If you have any questions, contact any of us. Also, of course, you can send questions to helpdesk@starweaver.com. Appreciate your patience, and I will pass it off to Doug and let him take it away from here. Hold on 1 second. Doug, you should be the presenter now.
Thanks, Paul. Well, welcome to the second in a series of 4 sessions on fundamentals of finance. As Paul said, this session is going to focus on financial firms and their role in the operation of the financial system. So this is diving into an aspect of the topics we addressed last week in the overview of capital and financial markets. Just a brief bit on my background. I have been an independent trainer and consultant for about 20 years now, but in the couple of decades up to that time, I split my time between the trading and training side of the financial businesses. So I did head up training groups at Citibank and worked for the New York Institute of Finance, managing a department or 2 there for a while, but also spent about half of my previous career in a variety of investment and trading capacities, working on bond trading desks, managing portfolios, derivative sales, and the like. So without further ado, let's dive into today's topic. So you see a list of the types of firms we'll focus on, although the bulk of the presentation will relate to the first 2, probably the most important of the financial intermediaries, certainly with regard to the capital markets and directing wealth into real investment, commercial banks and securities brokers, dealers. But we will spend a little bit of time talking about each of the various categories of firms over the course of the session that are listed there on slide 2. Just a brief recap of a couple of issues that were touched on last week. In fact, this slide and the next were probably addressed in a broader and more detailed fashion in session 1, so that for those of you wanting to pick up on that information, I'd suggest looking at the recording of the session on overview of the capital markets. But just to position what we're going to talk about today, it's important to have a clear handle on the different capacities in which the various financial firms can act in. So in simple terms, they can act as principal or agent. And the principal means the firm is acting on its own behalf. Now, some of you might say, well, the firm is always acting on its own behalf. But in a legal sense, we're talking about in terms of the performance of the contract. So when a firm is acting as principal, it's acting on its own behalf in the sense that it's taking the other side of the trade, or responsible for performance under the terms of the contract that are created as a result of the transaction between the firm and the client. And that means that the profit or loss that the firm is going to realize for this interaction is tied to the performance of that contract, the gain or loss on the securities trade, or the underwriting loss on the insurance policy, as it were. So just to give some specific examples of the types of firms we'll be talking about today, this would be a brokerage firm that when trading with a client, they're selling the client securities out of inventory, or maybe selling short, or they're buying securities from the client for their own inventory, or a bank making a loan, or an insurance company issuing a policy. So in each of those cases, the firm is acting on its own behalf in the sense that the performance of the investment or contract or loan will have a big impact on the firm's bottom line. The other general capacity financial firms can act in is in an agency capacity. In other words, they're acting on a client's behalf. So in that case, in a securities transaction, the firm is executing a buy or sell for the client, but the firm is not on the other side of the trade. It's simply providing the execution services. Or another example in the context of the firms we'll talk about today, an independent insurance brokerage outfit that might be selling policies on behalf of many different insurance firms, and presumably they're selecting the policy from the insurer that best suits the needs of the client. Now, of course, one of the big issues in any business is the agency problem. Is the agency really acting on behalf of the best interest of the client, or are they acting in their own best interest? In other words, when a broker is selling mutual funds to a client, are they placing the client in the fund that is best suited to meet the client's investment needs, or are they selling the client the fund that is offering the highest sales credit? Or similarly with an insurance broker, are they actually selling the policy from the insurer that provides the best protection, all things considered from the client's perspective, or are they directing the policies to the insurer that has wined and dined them to the most ostentatious degree? And similar to what we were just saying in the last slide, this is primary and secondary market is another issue that was touched on in the previous session. But again, to place that in context, specific to this example and for the issues we're talking about today, and for the benefit of those that didn't have a chance to see the previous session, the primary-secondary market distinction is probably more commonly made in the context of securities, but it has an analog for almost all of the different types of financial firms we're talking about. So primary market activity relates to the creation of the contract. Terms used in connection with primary market activity would be issuance or origination or underwriting. Issuance relating to securities, origination relating to loans or securities, and underwriting typically relating to insurance, although the term is also used in the securities business. So you can see there examples of primary market activity, lender making a loan, bank, but any sort of lender. That's the origination of loans, or a sale of securities either by or on behalf of an issuer. We'll look more closely at securities underwriting in a little bit, or an insurance company issuing a policy. Now, secondary market activity is unlike the primary market, which relates to the creation of these contracts. Secondary market activity is typically the exchange of already existing contracts. So while it's not near as active as the secondary market for securities, there is a secondary market for loans where the originating lender will sell the loan to some other party for a variety of reasons. In fact, an issue we'll touch on when talking about commercial banking a little bit later in this session. Or in the securities markets, the vast majority of trading is secondary market transactions. Probably the ratio of primary to secondary market transactions in the securities business is 17, 18, maybe 20 to 1. And that's actually a surprise for people not familiar with the securities business. There was a question on a questionnaire that was sent out by one of the major polling companies in the United States some years ago by one of the major financial companies, trying to assess the financial IQ of the American population. And the question ran something to the extent of, well, when a share of IBM is sold on the New York Stock Exchange, who gets the proceeds of the sale? And the choices were the NYSE, IBM, the selling investor, and I think the exchange itself. Well, of course, since the vast majority of transactions on the New York Stock Exchange are secondary market transactions, it's the selling shareholder that receives the proceeds in that case. And there is even a secondary market for insurance, which again is oftentimes invisible to those not familiar with the insurance business, but as we talk about insurance later, we'll talk about the reinsurance market. So we'll talk about commercial banks first, but banks is oftentimes a confusing topic for people as there are many different types of banks, and oftentimes the roles are quite distinct from that of the other types of banks. So commercial banks, which we'll talk about in more detail later, well, their key functions are taking deposits and making loans, but we'll leave it at that for now since we'll talk about them in more detail later. Whereas the classic investment banking activities are securities, trading, and underwriting. And again, we'll talk about that in more detail later. And of course, I'm making bright line distinctions here to define specific concepts, and in real life, these things often get blurred as many commercial banks will have broker-dealer subsidiaries through which they engage in many investment banking activities. Merchant banks, well, as is true in many financial terms, it depends on where you're sitting as to exactly what the phrase means. So that might have a different meaning in Hong Kong or London than it does in New York. But in fact, in Hong Kong or London, a merchant bank would be, in effect, an investment bank, although maybe a somewhat wider remit of activities. Whereas in the U.S., a merchant bank would be viewed as one that provides banking services to merchants or commercial firms. So that would include the investment banking and even the commercial banking activities we talked about already, but might also include things like trade or inventory financing, receivables, factoring, and the like. In fact, oftentimes a firm that engages in all of those various activities is sometimes referred to as a universal bank. In fact, in much of the world, the distinction between commercial banks and investment banks almost doesn't exist, as it was a creation really of the Glass-Steagall Act back in 1932 that separated commercial banking from investment banking in the U.S. And of course, Glass-Steagall was repealed, which has greatly muddied the waters in terms of having a clear distinction among these classifications I'm talking through here, as in many cases individual firms will engage in multiple of these different activities. And lastly, savings banks, originally a concept developed in Europe, but one that was adopted in the U.S. And a savings bank is one that has more of a consumer than the commercial focus that's primarily the case for the first three categories there. So it's primarily deposit taking and making loans to consumers, mortgages, and other sorts of similar consumer loans. So let's focus more closely on commercial banking activity in a bit more detail. So the classic activities of any commercial bank are taking deposits, savings accounts, checking accounts, CDs, and the like, or making commercial loans. In fact, if you engage in both of those activities in the U.S., you have to be organized as a commercial bank, either under federal or state banking laws. You can engage in either one or the other of those and not have to be registered or chartered as a commercial bank, but engaging in both absolutely requires that you get a commercial banking charter from one of the appropriate regulatory agencies. Now, beyond just those narrow descriptions of commercial loans and taking deposits, most banks, even small ones, provide a wide range of services. So payment processing, check processing and clearing, of course, but then a wide variety of activities that would fall under the rubric of cash management. So there's a lot of collection activities, whether it's receiving payments on behalf of some commercial entity, concentration services, where you might have a multi-location retailer or restaurant chain, where they're making their deposits at the local bank branch that they do business with, but for a variety of reasons having to do with economies of scale and managing costs and the like, they'd want to concentrate those monies in one or a small number of deposits. Well, the banks will engage in that concentration activity. They'll also provide lockbox services, holding funds for firms, and possibly for later use, which we'll talk about in terms of payment or disbursement activities in just a moment. But then many of these accounts will have a sweep function or be sweep accounts where funds above a certain level will be automatically directed into some investment, typically short term, but to generate some interest income on those funds while they're sitting in the institution. But the other side of cash management is payment or disbursement activities, so it might entail paying bills, whether it's utility bills or rent, taxes or the like, but also acting as the distribution of payments for wages for employees, acting as paying agent on a bond, paying interest or distributing dividend payments on behalf of some corporation, and of course wire transfer, moving funds around on behalf of the client. Now, treasury management actually might subsume a lot of those activities. Treasury management would entail putting together a suite of those sorts of activities and doing the management of funds on behalf of a commercial operation, on behalf of a business. So the idea is to manage the firm's cash holdings to mitigate operational, financial, and reputational risk. And so obviously the details of any specific treasury management service is going to be negotiated with the client, but would entail a lot of those collection and disbursement activities. And for large enough businesses, it might also entail some capital market or asset management activities, such as bond trading, trading currencies, or even derivatives as part of the risk management function. Now, let's look at a very simple but at least telling diagram of how a bank acts as an intermediary. So there's a stylized balance sheet of a bank showing its assets and liabilities. And the vast majority of banks get the bulk of their funding from depositors. And again, there's a wide variety of deposits, savings accounts, checking accounts, certificates of deposit and the like. But then, of course, the bank needs to do something with that money so they can return the money with interest when the depositor makes the withdrawal, as well as cover their operating expenses, rent, salaries, and the like, and ideally have money left over to distribute as dividends to the owners of the bank. So that money will be taken and loaned out to some borrower. And then, of course, the borrower has an obligation to the bank, and now there's a loan sitting on the balance sheet. Now, obviously, commercial banking is much more complicated, and the last session, and again, if this is helpful, if you want more detail, look at the recording of the last session, but commercial banks are a key element in the creation of money, but we'll not get into fractional reserve systems now, as this is more focusing on the role in the operation of the financial system, not the monetary system. All right, so let's now, and one other important point to make about the bank will have, in this situation anyway, an ongoing relationship with both the depositors and the borrowers. So the bank is acting as an intermediary in an ongoing sense, is that it's interfacing with both the providers of funds as well as the potential user of funds and into real investment, as those borrowers, if they're commercial borrowers, are likely borrowing that money to somehow enhance the productive capacity of the firm or make the firm more efficient. So let's now consider the activities of broker-dealer firms. Now, what a broker-dealer firm is, note it could be a natural person, that is, as opposed to a person under law. I don't want to say unnatural person, but corporations, trusts, and the like have an independent existence for legal purposes. So a broker-dealer could be an individual person or a corporation or other business organization. and it is organized to trade securities either for its own account or on behalf of others. And so we'll expand on that when we go into the functions. It's just below that on the slide. So not all, but many broker-dealer firms engage in retail brokerage activity where they're buying and selling securities on behalf of their clients. And that would include not just stocks and bonds of business corporations or exchange-traded funds, but might also include distribution of mutual fund shares, as well as redemption on behalf of the fund company. And of course, those might be captive or internal funds run by the asset management arm of the firm, or they might be funds run by a third-party fund family, a Fidelity or a Vanguard or somebody like that. Now, when engaging in pure retail brokerage, unless the firm is selling from inventory, that relates to the agency capacity in which firms can act that was introduced earlier. The next two sub-bullets there represent types of principal trading activity, market making and proprietary trading. Now, in both cases, the firm is trading for its own account. The purposes of the activity are driven by different goals. So market making, or the firm would be referred to as a market maker, might also be referred to as dealers, buying and selling for the account of the firm. In the UK, they'd be referred to as jobbers, just to give you a flavor of the different terminology you'll run into at in different financial markets. And in the goal in market making, while there might be some positioning, the primary goal of market making is to make money by providing liquidity, capturing the bid-ask spread. And again, these were issues that were discussed from a slightly different perspective in the last session. But the other way that firms will commit capital is into proprietary trading. Just to tie this into more recent events, that was one of the things that the Volcker rule was going to potentially place limits on for commercial banks to engage in proprietary activity. So proprietary trading just means the firm is committing capital to a trading position. So they're trying to buy things they think are going to go up and sell, or short sell things they think are going to go down, as opposed to market making, where you're typically buying and selling the same security, simply trying to capture the difference between the buying price and the selling price in the short run. Proprietary trades might be commitments of capital that are short-term, hours or days, but in many cases they might be more strategic and might have tenors of months or even years. And then investment banking. Now, we introduced the idea before. The classic investment banking activities are securities underwriting and trading. Well, we just talked about the two types of principal trading just a moment ago. And securities underwriting, we'll look at a diagram of that on the next slide, but that is selling securities on behalf of some issuer. But most investment banks engage in a broader range of activities. So they will oftentimes engage in advisory activities, whether it's advising on M&A, mergers and acquisitions activities, or sometimes it's more strategic in nature, helping firms decide on appropriate directions for some commercial firm to take in terms of what businesses to go into if they're not in already, or maybe which businesses to get out of by divesting themselves of subsidiaries. And asset management, and again, a wide range of the firms we'll talk about engage in asset management activities, but oftentimes broker-dealers will have an asset management subsidiary. And that might be mutual funds. We talked about internal mutual funds before, type of investment company formally, but most people know them here as mutual funds or as unit trusts in the UK. Might be wealth management, asset management activities, for the high net worth clients, because typically one of the range of services offered to wealthy clients would be managing money on their behalf, or it might be managing pension or retirement funds. Now, the underwriting that was referred to a few moments ago, and this is a diagram similar to one that was introduced last session when we were talking about the primary market. And the primary market, again, is the sale of securities by or on behalf of an issuer. Now, some issuers, like major country governments, sell securities so often that they don't need to make use of an underwriter. And not in all cases. Some issues in the UK, actually, they'll sell through an underwriting syndicate, as is true of some issues of the Japanese government. But in the case of the US, and I think also true of the German government, they just announce a sale, and then there's a yield auction for direct sales to bidders competing to buy the securities being sold by the government. But most corporations, and in fact oftentimes government agencies, since they don't sell securities as frequently or in such large quantities, the distribution of the securities will be managed on behalf of the issuing corporation or government agency. So in a firm commitment underwriting, which accounts for the vast majority of securities underwritings, the manager and the underwriting syndicate are making a commitment to provide an issuer with a certain amount of money for the distribution of some stock or bond offering. So in effect, the manager and the syndicate members are buying the securities from the issuer. This is a principal activity, so the underwriting syndicate, they've made a firm commitment to deliver the promised funds to the issuer, regardless of how well or how unsuccessful the subsequent offering to investors. So the syndicate then attempts to turn around and distribute those securities to investors, and of course they're hoping to get more money from the investors, and they've promised to pay on to the issuer. Now, note that the manager and the syndicate members will not have an ongoing relationship with both counterparties to this transaction, to the two sides of this transaction, as was true of the commercial banks with its ongoing relationship with both depositors and borrowers. Because once the offering is completed, the investors have a direct relationship with the issuer. Either they've become part owners as purchasers of stock in an equity offering, or they've become creditors of the issuer in the case of some bond offering. Now, in this diagram and the similar diagram for the banks, I've made what is maybe a too clear of a distinction between the roles performed by banks and brokerage firms, or firms, investment banks acting as underwriters. Because again, most commercial banks will have broker-dealer subsidiaries through which they provide these sorts of services to corporations. So let's look at the muddiness of the waters in a little bit more detail. Oftentimes, people not familiar with the financial businesses will think there's a great distinction between bonds and loans. Well, actually, a bond is a type of loan. It's just a loan that's been packaged in a way, and by packaged, I mean it's dotted all the I's and T's with respect to satisfying the regulatory or legal requirements, such that once that bond has been issued, it can easily be sold to another investor. So loans can be sold by the originator, but generally the secondary market for loans is much smaller because loans don't have the same standardization, and in effect the origination of the loan didn't jump through the same number of hoops that a securities issuance has, so as to facilitate subsequent trading of the bond once it's outstanding. But let's look at the distinctions that people sometimes make. So loans are oftentimes viewed as an obligation of one borrower to a single lender, whereas, and under bonds you see a variation of the diagram from the previous slide, issuers sell securities, in this case bonds, to the manager and underwriting syndicate for sale to investors. And so oftentimes it's thought that there's a single borrower, but potentially many investors in a bond offering. And that's sometimes a false distinction, as we'll see. Because think about a really large loan. If JP Morgan Chase has been contacted by an ExxonMobil for a $5 billion loan, it might well be that JP Morgan Chase doesn't want that great a concentration of credit risk from a single borrower on its balance sheet. So oftentimes very large loans are syndicated, where there will be a lead bank that's negotiating the terms of the loan with the borrower, but then they'll be in effect sourcing funds from a wide variety of banks, and I stuck with 4 in this example due to space limitations, but conceivably just as an underwriting syndicate might contain dozens or even hundreds of firms in the underwriting syndicate, syndicated loans can be syndicated across dozens or conceivably hundreds of banks depending upon the size of the transaction. And then to give the full complication there, note that in many cases there are securities offerings that are placed with a single investor. Now this is more typical in the private placement market, but you'll have a direct negotiation of the bond offering between the issuer and a single investor. And just to further muddy things a little bit, let's look at the bank and its ongoing intermediary role, which it doesn't always maintain. because as was indicated earlier, there is a secondary market in loans where loans can be sold. And something that's actually become a major activity over the course of the last few decades is asset securitization. So oftentimes, rather than selling the loan to another investor, what the bank will do is set up a special purpose vehicle. The special purpose vehicles for most asset securitizations are trust accounts, although there are a wide variety of different trusts, and this is not the place to go into the detail, although some of this detail will be addressed in the next session when we talk about fixed income markets. And then once that special purpose vehicle, SPV, has been set up, the bank will end up transferring various loans of certain types into the trust account. And then interest in that trust account will be sold to investors. And you'll note, as has been designated on the arrow pointing to the investors there, the types of securities issued are oftentimes mortgage-backed securities or asset-backed securities or collateralized loan obligations, a variation of the CDOs, collateralized debt obligations, that didn't pick up such a bad name in the last financial crisis. So while the market for CDOs has greatly dried up, there is still a fairly active market in collateralized loan obligations for prime loans. And of course, one of the reasons for doing that is the bank is getting funds back from engaging in that activity. Now, one might wonder, well, what's the purpose for doing this? And there's actually a wide variety of reasons for doing this. One obvious one is that it gives the bank an ability to manage the risk of its balance sheet. And oftentimes when people hear risk management, they think risk reduction. Really not the right way to think about it. Risk management is more properly thought of as right-sizing risk. So in the first wave of CLOs back in the early years after the turn of the millennium, the banks were actually selling their prime corporate loans into CDOs or CLOs because the prime borrowers, of course, pay very low interest rates, and they were actually dumping the high quality but low income assets off the balance sheet into these trust accounts as a way of freeing up capital to make somewhat riskier loans, as a way of trying to generate better net interest margins. But there's other reasons beyond managing the risk of the balance sheet. It might be a way of increasing the ability to make loans. One of the primary sources of income to many banks are the loan origination fees. And if a bank is fully loaned up, if they hold as many loans on their balance sheets as their current capital holdings allow, that could constrain their ability to generate income. So by selling loans in this fashion, it in effect frees up capital to make new loans and generate additional origination fees. And also, this can be just a cheaper source of funds, especially if the quality of the loans in the pool are high quality enough. Investors having a direct claim against a trust account holding high quality assets will oftentimes be able to be sold at much lower interest rates than bonds, straight corporate bonds issued by the bank that just represent a general claim against the bank's balance sheet, as opposed to investors in this situation having a specific claim against particular assets that are ring-fenced, that are completely separate from the bank's own balance sheet. So it means the investors have risk tied to the performance of the loans in the special purpose vehicle. They don't have any risk exposure to the bank's balance sheet in general. Now, aside from the banks and brokers, let's take at least a brief look at some of the other major categories of financial firms. So one important type of financial firm is insurance companies. Of course, ultimately, insurers as investors are on the buy side of the market, but let's focus on the insurance function of the insurers. And I've got listed here some of the more common types of insurance that many people are either familiar with from personal experience or clearly have heard of, although there are clearly many other types of insurance, business continuity insurance for business disruptions due to any number of factors, or personalities, rock stars might insure their voice, or actresses have insured their legs. So there's a wide variety of things that insurance companies will insure. But some of the more common types, property casualty insurance. Now, many of you are likely familiar with that from your auto or home insurance, but businesses will also insure their properties against damage due to fire or theft or other natural disasters such as hurricanes or floods. or even man-made catastrophes. When the World Trade Towers were taken down, the towers were insured against terrorism, as a matter of fact, and that actually turned into a major court battle, whereas the insured was claiming it was two separate terrorist acts, and so they could collect on the policy twice, or the insurer wanted to contend it was a single act of terrorism. So some interesting legal sidelight there. Then there's also life insurance, and I probably should have listed life insurance and annuities next to one another, as life insurance companies oftentimes sell annuities as well. So life insurance is insurance against death, and obviously the insured in that case doesn't benefit, at least not by collecting on the policy, although the beneficiaries, the insurance has been taken out to benefit the wife or the children, or even the business, as you can have key man insurance. And annuities, well, that's almost like insurance against living too long, at least with a life annuity, because on a straight life annuity, the annuitant will receive payments until the death. Well, there's various structures, and this is not the place to go into distinctions between pure life annuities as opposed to joint and last survivor policies and the like. And in terms of different types of life insurance, there are term life insurance, where you're buying life insurance for a set period of time, and one is paying a premium purely for the insurance protection, as opposed to whole life insurance, sometimes called permanent life insurance, which will run for the life of the borrower, at least as long as they're paying their premiums. And whole life insurance will have a savings feature as well. So there's a cash value build up that the policy can be turned in to collect, even if one doesn't die, or one can borrow against that cash buildup. And there's even more complicated policies, sometimes variable or universal life, similar to variable annuities, where unlike a fixed payout, there'll be a payout that's tied to the performance of some investment. And then health insurance, which provides a benefit to meet various expenses related to, well, potentially doctor visits, but more typically for hospital stays or operations and the like. And beyond just the straight selling of insurance, there's also, in effect, a secondary market insurance. That's the reinsurance market. And the reasons for selling some of the insurance risk that the original insurer took on, well, of course, for reinsuring the policies they've issued, the insurer that issued the policy has to give up some of the premiums. But it's a way of insurers managing the risk of their insurance portfolios, as well as freeing up the ability to sell more policies, because obviously one needs to maintain, or insurance companies need to maintain reserves against the outstanding policies, and that's a function of the risk they've retained. So by dumping some of that risk off the reinsurance market, it opens up the ability to sell additional policies. And just for a little bit of color there, you can see some of the more well-known reinsurance companies. Now, Berkshire Hathaway also issues policies. Anybody in the U.S. has seen Geico, which is a Berkshire Hathaway subsidiary that sells auto insurance. But one of the major activities of Berkshire Hathaway is in the reinsurance market. But other major reinsurers are Swiss Re and Munich Re, the Re, of course, being short for reinsurance. And then there's even the possibility of reinsuring to the reinsurance. So retrocession insurance is when the reinsurers are selling off some of that risk, again, as a way of managing the risk of their insurance portfolios. So the reason for insurance, well, the insurers can have a better ability to manage the risk of having to make payments on policies, because they can pool those risks, as opposed to if we all self-insured, we'd have to build up savings on our own. And to the extent that there are a large number of policies issued, it's very unlikely that they would all be collecting at the same time, and so that in effect, portfolio management allows a diversification of risks. And of course, from the insurer's perspective, it's best to have a large number of similar risks that are in a given risk pool. Similar risks in the sense that you wouldn't combine auto policies in a portfolio with life policies, because the nature of the risks are very different. And so if you have a bunch of similar risks, you can make, in general at least, better estimates as the number of autos that will be involved in a wreck in any period, or the number of those with life insurance that will die in any one year. And the larger the pool, the greater the reduction in the impact of random events, as with very, very large pools, the greatest likelihood is that the experience of a large pool will reflect long-run averages in terms of the types of events that would occur that would require some payout on the policies. And naturally, you want to price the policies to reflect the risk of those insured in the pool, plus a little bit more, because of course you want to generate some profit as well as build up a reserve for those years when in earlier periods there are greater than anticipated incidences of events that would require some payout on the policy. And policy payouts, depending on the type of policy, might be recognized either as an indemnification or a benefit. Indemnification meaning a compensation for a loss, like an auto wreck, or maybe it's not a wreck, maybe it's just a fender bender, and so the size of the collection would relate to the amount of the damage, as opposed to a benefit. Well, of course, that would relate to life insurance policies or annuities, where the payment is not specifically tied to the potential economic earnings of the person buying the life insurance policy or the annuity. And sources of revenue from which the insurers will be able to meet their obligations is presumably some combination of premiums they collect on the policies that are issued. You sometimes hear the phrase underwriting losses. That would be a period of time when the payouts on policies exceed the premiums collected in that time period. But generally, insurers build up investment portfolios, and so the returns on those investment portfolios provides another source of money to cover underwriting losses in any given period. And subrogation is a term that refers to the insurer assuming the rights of the insured. So when the auto is wrecked, well, the insurer owes the wrecked auto if they make a payment full on the policy. Or it assumes the rights of the damaged party to sue the party is responsible for the damage in some personal injury situation. In terms of asset management companies, the presumed benefits of asset managers are listed at the top there. Rather than investing on our own, we hand our money off to an asset manager simply because of their expertise, their greater ability to achieve diversification, and the economies of scale that they can achieve. The last two are absolutely true. The first might be a little bit open to question. Because first off, expertise, well, are you investing in a diversified portfolio? One that includes stocks and bonds and real estate and currencies? Well, it might not be possible for one person to be expert across a wide range of asset classes. So there's also many specialized funds that invest in a specific sector of the economy or a specific type of security. So a fund that might just invest in bank stocks, or a fund that might just invest in mortgage-backed securities. But the reason I quibbled about expertise, one of the trends in finance for many decades now has been increased indexation. In other words, buying an indexed fund that tries to replicate the performance of a specific sector. And something like the U.S. equity market, there are many S&P 500 funds. In fact, for a long time, the Vanguard 500 fund, which is a fund that replicates the performance of the S&P 500 by holding all 500 stocks in exactly the weight in the portfolio that they are reflected in the index itself. On the other hand, while the equity indexing has been around for nearly half a century now, it's only in the last 20 years or so that indexing has become a big deal in the fixed income sector. And for a long time, that was because it was harder to collect statistics on fixed income performance versus equity performance because of the difficulty of tracking over-the-counter transactions and true prices and returns and the like. Well, now that the world is so automated, we've been able to look at the statistics, and it turns out that active managers tend to underperform the indexes, at least over time. In general, the statistics are in any one year, only 25% of active managers are likely to outperform the index they're trying to replicate the performance of. And that's on average, and it's always bad to think in terms of an average as an expected value. It's just an average. In some years, nearly all the active managers beat the indexes they're benchmarked against. On the other hand, in some years, the benchmarks beat nearly all the active managers. But note I cited a 1-year statistic so far. Over 5 years, it's likely less than 10% of the active managers can outperform their indices. Over 10 years, it's probably less than 5%. So in the long run, and it's primarily a function of transaction costs, active managers tend to underperform the indices, which is why there's been an increasing growth in the indexing of investment funds. The complication of the fixed income area is that many fixed income indices, like the Barclays Total Market Index in the U.S., will include maybe as many as 4,000 bonds. So it's very difficult to hold that number of bonds in exactly the right proportion. So most bond index funds are what they call enhanced index funds, where they're only holding a subset of the securities in the index, but the securities are selected not to try to outperform the index, but rather to replicate the performance. Now, some specific examples of asset managers are, aside from the captive asset management companies of the brokerage firms and the banks that we talked about previously, bank trust departments. And note there are other types of asset managers than the ones listed here, hedge funds, commodity pools, and the like. But pension plans, now a defined benefit pension plan is one where the company is promising a certain payout based on whatever the appropriate formula is, based on number of years of service, highest earnings, average earnings the last 5 years. There are many different ways of structuring the formulas, but there's a promised payout based on some formula. In that case, the investment risk is on the company or the government that's promising the retirement benefit. Increasingly over the last few decades, we've seen an increase in defined contribution plans, where the employer is simply obligated to set aside a certain amount of money, and then that foists the investment risk off on the beneficiary of the pension plan. Note, that doesn't mean that the individual is investing the money blindly. Typically, the vast majority of defined contribution plans will have a list of permissible investments, typically a range of mutual funds provided by some asset management company. And very seldom can you invest in common stock, although if it's a private corporation, oftentimes the company's own stock is a possible investment. Then investment companies, the mutual funds are formerly known as open-end management companies, but there's also closed-end management companies. I won't get into the distinction between the two, but closed-end management companies are probably more like exchange-traded funds in that they trade on exchanges at a certain market price, as opposed to mutual funds, which in effect are issued and redeemed over the counter. In wealth management, it's just noting a specific type of service offered to the high net worth or the private banking clients, usually as part of a portfolio of services offered by the wealth manager that might include trust services and loans, as well as asset management. And then lastly, the depository institutions. So aside from the commercial banks we talked about previously, the other main categories of depository institutions in the U.S. are known as either savings banks or credit unions. Now, we introduced savings banks earlier, so they're like commercial banks in that they take deposits. They also make loans, and in the U.S., actually, they're able to make a limited number of commercial loans to certain types of entities in many cases, but the bulk of their lending activity would be geared towards consumers, mortgages, auto loans, and things like that. So savings banks are also known as thrifts or thrift institutions or savings and loans. The ownership structure might be either shareholder-owned or possibly mutually owned, in other words, owned by the depositors. And they're primarily taking consumer deposits. Again, depending upon the state, in some cases they can engage in a limited amount of accepting deposits from certain types of businesses. But to be considered a savings bank, there are great restrictions on the asset holdings. They have to be considered a QTL or qualified thrift lender, as noted there. And of course, any regulatory calculation is much complicated than I'm going to present it right now. But the general rule is that for various exemptions and so forth, 65% of their assets have to be in consumer loans or mortgages. And lastly, credit unions. It might be a distinction without a difference comparing credit unions to savings banks, but the reality is that a credit union is formed to benefit a certain identified group of employees, might be federal employees or employees of a certain business, or people living in a certain area, or people that used to work in the military. There's credit unions for all of those different groups I've noted. So they're mutually owned in all cases. And again, they will engage primarily in accepting deposits from consumers and making loans to consumers. Although again, depending upon the regulatory environment, they might be able to engage in some activities with small businesses. So we've come to the end of the session, and I hope all the listeners have found the information useful and informative. And I'd be happy to accept questions regarding any of the issues talked about or things related thereto.
Thank you very much, Doug. Paul again. Everyone, there are lots of nuances that Doug has covered in a very short period of time, so it would be hard to imagine that everyone has completely absorbed everything, so please feel free to ask questions, chat them on the side here. We'll field them for Doug. My experience is quite interesting in so far as we've done programs in the past where we thought the audience needed an advanced asset-backed securities course, and at the end of the day, we learned that many people were not familiar with how asset-backed securities were structured. So my experiences, and what happened was once we did that, we took the course back to a more introductory core level program. Everyone quickly absorbed that information, came up to speed, and learned an enormous amount. So if there's even some fundamental questions you have, please don't feel shy about asking them. That's why this is being conducted, to give you the confidence and the ability to probe and understand more about the financial sector. And Doug is an expert in the field, as I think he's demonstrated, and can be helpful to you. Of course, if you have any questions hereafter, again, forward them to helpdesk at starweaver.com. Doug will be able to field the questions and get back to you. And again, we have a few more minutes, so I think I'll keep the microphone open for another minute or so. Again, you may have questions about how this applies to you. And we have an interesting question came in. Doug, for you, can you please give some detail around agency, principal capacity, and prop trading? It's a bit confusing to me.
Sure. Well, agency and principal, again, it's sometimes not clear to people unfamiliar with the business because they assume a firm is always acting in its own interest, and that's why I tried to bring up the agency problem. But principal means that the firm is trading for itself, and I'll be repeating myself a little bit because I want to keep the explanation straightforward. But that means the firm is on the other side of the trade from the client. So that literally the stock the customer is buying, the firm is selling to the client from its own inventory. As opposed to an agency securities trade, which would be where the customer places a buy order with the firm, but rather than the firm selling to the client out of inventory, they've gone to some other brokerage firm and bought the security from the other brokerage firm on behalf of the client. So the presumption in that case is that the firm itself doesn't have a conflict of interest, because when the firm's on the other side of the trade from the client, are they really getting the best price for the client? Whereas if they're simply taking a fee for executing the trade, presumably they're looking to find the best price they could possibly get to keep getting more of that client's trading business in the future. But that distinction I made between an agent not having a conflict of interest, whereas if the firm's on the other side of the trade, there's an inherent conflict of interest, that's probably a false distinction in the sense that the New York Stock Exchange tried to hold itself out as a better place to trade because all trades on the New York Stock Exchange are agency transactions. The broker executing the trade is never on the other side of the trade from the client. They're bringing together buying and selling clients and matching those orders. And the New York Stock Exchange would try to represent, well, see, we have no conflict of interest whatsoever, whereas if you trade with a firm in the over-the-counter market on NASDAQ, in many cases the firm's going to be on the other side of the trade, and there's at that point an inherent conflict of interest. Well, there have been numerous studies done, as you might guess, and because of various regulatory rules in place, like FINRA, used to be the NASD, had what they called a 5% markup policy, and the number is misleading, but the point of the policy was that firms could only take a markup, the analog of the commission, because in a principal trade you don't have to disclose the commission, whereas in an agency trade you would. And so the markup would be buried in the price. But there were numerous studies that looked at markups versus commissions and transaction prices and where you got the best deal. When you compared similar sized trades and similar securities, there was statistically no difference in terms of the compensation firms were paying, whether they bought a stock on the NYSE or they bought a stock in the over-the-counter market.
Thank you very much, Doug.
You're welcome.
Again, everyone, I think that that's the kind of question we were looking for. Things that may seem obvious to many people are not obvious to most. So the fact is that things that maybe Doug is very familiar with because he lived it for so long and uses shorthand may not be familiar to you. My experience also, especially if you're a technologist working in the finance sector, you're thrown terms right and left. There's a lot of jargon in the industry, and I'm not talking about technical jargon related to programming and development and business and systems analysis, but I'm talking about the finance jargon. And hopefully we've covered a lot. Doug's covered a lot of that here today. If there are no more questions, we'll wrap it up. But again, please do feel free to forward your questions to helpdesk@starweaver.com. This is a session that you should, and I recommend you go back to listen to. It should be up by tomorrow. We'll send you all emails. And once again, thank you very much, Doug, for a wonderful session, and everyone else for participating. And we hope you have a great week and a great holiday coming up.
My pleasure. See you next week, Paul.
Take care.